And if we keep waiting for foreign investors are very smart. They are not going to come.
Dangote just said something no African billionaire at his level has ever said publicly. He said, when Africans don't invest in their own continent, why should we expect foreigners to invest in Africa at their own expense? That is not a motivational statement. That is a trust deficit laid bare. If Africans themselves do not believe their continent is worth investing in, why would any foreign investor reach a different conclusion? And the man saying it is the same man who staked more than $20 billion on the opposite belief and proved that investing in Africa is profitable. But here is the question nobody is asking. If foreign investors were never coming to industrialize Africa, what exactly were they doing here for 60 years? African governments competed aggressively for foreign direct investment by issuing tax holidays, special economic zones, going into bilateral investment treaties that gave foreign corporations legal protections African businesses never received in their own markets. The assumption underneath every one of those policies was identical, that if enough foreign money came in, industrialization would follow automatically. Between 1970 and 2020, Africa received approximately $1 trillion in foreign direct investment. In the same period, the continent's share of global manufacturing output dropped from 3% to 1.5%. $1 trillion came in, Africa became less industrialized. Nigeria tells that story most precisely. At its peak in the 1980s, Nigeria had 167 textile mills, employing over 500,000 workers directly. Kaduna was the textile capital of West Africa. The industry clothed a nation and anchored an entire regional economy. Then the sap arrived. In 1986, under IMF and World Bank pressure, Nigeria floated the naira, removed trade barriers, and opened its market to imported fabrics at prices no domestic mill could match. By 1998, the textile industry was operating at just 28% capacity. Between 1994 and 2005, 64% of registered textile companies disappeared. Employment collapsed from 137,000 to 24,000. Drive through the Kakuri industrial area of Kaduna today. Overgrown weeds, crumbling structures, skeletal remains of factories that once ran 3 shifts a day. Which raises the question, if that money was not building industry, where exactly was it going? The $1 trillion did not disappear. It went exactly where it was designed to go. It bypassed factories entirely, flowing into oil wells, mines, and extraction infrastructure. While Asia built manufacturing hubs, Africa's FDI left its industrial base hollowed out. Raw materials flowing outward at commodity prices, returning as finished goods at retail premiums. The reason is structural. An industrialized Africa competes directly with factories, refineries, and chemical plants already operating in the home market of the investor. African industrialization transfers the entire value chain, the engineering, the financing, the management, the intellectual property, the profit margin, directly threatening the economies the investors came from. Foreign capital did not fail to industrialize Africa. Foreign capital was never designed to industrialize Africa. The structural adjustment programs made this explicit. African governments were conditioned to liberalize trade, remove industrial subsidies, and keep markets open to foreign finished goods, in exchange for loans requiring the very policies preventing domestic industry from forming. Raw material provider, finished goods consumer, that was the offer. It was never industrialization.
The tragedy of Nigeria began in 1986 when we did the structural adjustment program. When we were persuaded to devalue our currency every week for 32 years.
But if the $1 trillion was not building industry and it was not staying in Africa, where exactly did it end up? When you combine profit repatriation with debt servicing and illicit capital flight, Africa exports more wealth than it receives in FDI and aid combined. In 2018 alone, Africa lost $88.6 billion through illicit financial flows, flowing directly into the same Western financial systems, simultaneously offering development aid as solutions to African poverty. The aid comes in through the front door, the capital walks out through the back. This is not a conspiracy, it is arithmetic. And it is the arithmetic Dangote understood before he broke ground with his commitments. His argument is structural. If African capital builds the infrastructure first, the regulatory environment follows the money, because the money is now domestic. Governments protect what their own investors own. A clean thesis, but a thesis is only as credible as the evidence behind it. So what happens when you actually test it? Dangote did not make this argument from a podium and leave it there. He capitalized it. $20 billion into the Lagos refinery, African institutional capital shouldering the foundational equity risk of a mega project. The Afrexim Bank $2.5 billion facility, the NNPC government equity stake, African capital at the core, not foreign equity collecting the return. Nigeria went from importing more than 90% of its refined petroleum to meeting the vast majority of domestic demand from a single African-owned facility in under 2 years. That's what African capital deploying at industrial scale actually produces. His 2030 expansion, the East African refinery, the Ethiopia fertilizer complex, the Pan-African IPO architecture is the same thesis at continental scale. African capital, African infrastructure, African returns in US dollars. The decades-long experiment of courting foreign investment produced half the manufacturing share Africa started with. One man deploying African capital produced a functioning continental energy anchor in 11 years. The data has delivered the verdict, but the verdict only matters if the right people act on it. Foreign capital was never coming to industrialize Africa, not because Africa was not viable, but because a dependent Africa, supplying raw materials, consuming finished goods, and recycling savings into Western financial systems, was more profitable to the global economy than an industrialized one. That calculation has not changed. What has changed is that African capital is now moving. Dangote proved the model works. The returns are being structured to stay on the continent. But the model only scales if African investors show up. Not foreign investors waiting to be convinced, not development institutions weighing political risk. African investors with African savings, African pension funds, and African institutional capital deploying into African infrastructure at the scale the continent has always required. Dangote stopped waiting 60 years into the experiment. The question is whether African capital follows or spends another 60 years watching from the outside while someone else builds what should have been built here all along.